And joining us for a further look on what's playing itself out in that market scene is Richard Court from Argon Asset Management. Richard, thank you so much for being with us today, and good afternoon.
Good afternoon.
All right, lots to digest, I think, happening around the world. We've got that Eurozone inflation that's just come out, which does show it's a bit of a mixed bag, I'd say, but mostly that part of the world is battling a little bit to edge out some growth. Keen to get your thoughts on that, but also what we're seeing on the local markets here, a really tough time for some of our telcos, something we don't see often.
Yeah, so at the moment, I mean, there's, as I'm sure we're all aware, there's a lot going on in the world at the moment. But the Eurozone definitely seems to be struggling a bit more than other parts of the world. Yeah, so trying to drill down a bit deeper than just looking at the Eurozone as one market. I mean, places like Germany, like flirting with recession, like sectors within the German economy under taking strain, dealing with oversupply, lack of demand, getting to grips with supply chains that are readjusting or disrupted due to geopolitical conflicts. And now we're seeing, well, I wouldn't, not riots yet, but strikes by French farmers in France around Paris. So it doesn't bode well in terms of like the sentiment for like equity markets. So it does put a dampener on share prices at like holistically, not necessarily on a stock by stock basis.
Also keen to get your thoughts on what we're seeing here at home, Richard, with the Rand. You know, the Rand seems to be faring okay under the circumstances here. We are expecting the Fed to come out with a decision this week. I'm wondering if, you know, the Rand can enjoy some stability now, seeing as the general consensus is that we're in a hold environment.
Yeah, look, in the short term, it's very difficult to predict, and like it's to the point where it's impossible to do so. But South Africa is not it's it's not an island, so we sort of have to take our cues from what's happening in the rest of the world. I think everyone is watching what's happening in China and in the US quite closely, not in terms of monetary policy and also just in terms of their economies. And I don't think South Africa is alone in this. If we look at across sub-Saharan Africa, over the last year, a lot of African currencies have depreciated sharply against the US dollar. So like as a basket, it's a lot of them appear to be quite undervalued.
And let's chat a little bit about China. I think after those news of Evergrande, we are still waiting for government to make a move. But I anticipate that markets will be pricing themselves, pricing all of that in. You know, the eventuality that this property market in China has changed for good, and the chances of it recovering are slim or none.
Yeah, look, I mean, I think it was recently announced that China Evergrande had been placed into liquidation. That wouldn't have been a surprise to most people. I mean, the China Evergrande's this has been coming for about 3 years now. So in and of itself, it wouldn't have shocked the market. However, it's just another data point in like adding to the pessimism around the Chinese property market, and then by extension, the Chinese equity market. There would be concerns around like a negative wealth effect. If you've got Chinese homeowners who suddenly find that their home that they bought 2 years ago is now worth significantly less than what they first paid for it, you know, their equity values declines, even if they are, you know, they're not. Well, what that does is it just makes them a bit more pessimistic. It makes them a bit more conservative, and it makes them just a bit more like pragmatic in terms of like what they spend their money on. So it puts a bit of a dampener on things, and that like sort of overflows into equity markets. If you look at like Hong Kong and China, those equity markets appear to be, or they screen very cheaply. So this is not overnight. I mean, those markets have been under pressure for a while now, and a large part of that has been the concerns around the Chinese property sector.
A big one we are anticipating today, Richard, is of course what we're seeing with Microsoft and Alphabet. I'm keen to get your expectations here. These are companies that have done well at a time when other companies were barely, bringing out any value. They seem to have fared okay. But I'm wondering, as we expect these earnings to come out, are we expecting them to shoot the lights out? Is there potential that the craze around AI could continue to do that for these firms?
Yeah, so both Alphabet, so like we might know it better as Google. So like Google and Microsoft are two of the Magnificent Seven. So like these are two of the seven stocks that have really dragged the US equity markets high over the past year. A large part of that, so it's been tech driven. So the other five constituents are also tech companies. In Microsoft's case and in Nvidia's case, it has been specifically around AI and the embrace of AI going forward. So Microsoft has been a beneficiary of that to the point where it's now, I think it's pipped Apple as like the largest company in the world by market cap. So in terms of ability to shoot the lights out, well, the market has got a very high rating for Microsoft, to the point where it's sort of like comparable now on a forward PE multiple to what it was in the dot-com boom. So the expectations are very high. So it's not just about their ability to generate a significant amount of earnings, but it's just that relative to what the market expects them to do. So both are very good companies, make no mistake. But if the market is placing too high an expectation on them, it is possible that the share price might. It's possible. I don't think it will happen, but it's possible that there could be a bit of a shock to the system. But it won't be. It won't be significant.
Well, before we get here to our clip, Richard, I'm curious to get your thoughts on ShopRite. They've shot the lights out. It looks like, consumers really defaulting to them as a discount retailer.
Yeah, so the market really liked the trading update. I think it was up like over 2% this morning. So it's just another data point, like confirming ShopRite's dominance in the food retail sector. As you said, on the SA supermarket segment, which is like 80% of their sales, like grew revenue by double digit. But it was interesting on a like-to-like basis, it was up just over 6%. But food inflation, well, they internally measured food inflation was like 7.7%, which means that their volumes that they sold actually declined compared to the prior period. So I think that just points to just the state of the South African consumer. We just things are a bit tighter, things are a bit tougher, and people are buying slightly less.
Before we move on to your stock pick, Richard, I'm keen for us to reflect on counters that have found favor with your industry peers.
I'm going to be very conservative, and this is not for everybody. It is an exchange-traded fund. The code is QDIV. It is called the Global X S&P 500 Quality Dividend. If you want to make oodles of money on capital growth, this is not the stock for you. It only did 5% last year. But the reason I'm recommending it for some people is that we're kind of in a bit of a market no man's land. Interest rates are probably going to be decreasing in 2 months, 3 months, depending on where your view is. You've really had just the big growth stocks really had a big blowout. I don't know about how much further they can go, if they can go further. So you're in a holding pattern. So some people are not able to access money market funds where you have that 4.5% interest rate. So this is a nice alternative because the companies are mainly in the consumer staples, the healthcare, and the industrials area. So it has about a steady 4% yield, and there's relatively little volatility in the companies that you hold. So I would always look at it as the money market proxy if you are not able to access money market interest rates.
I think retail is a good space to be in. So I had my pick as Truett.
Okay.
In addition to the kind of stuff we talked about earlier, they've also got they're keen to buy back shares, so that always is a nice thing for investors. But yeah, the growth in sort of the UK, hopefully that continues. The kind of less than expected sort of decline in Africa was always a welcome thing. And of course, I think the lack of love the sector has received from the investment community is probably going to kind of pique people's interest again. So I think Truett is a good, I think retail in general, I suppose, is a good option.
I'm going global. Last year, large cap US tech was the only game in town, but I think we could start to see that shift somewhat. So I'm going for the iShares MSCI Emerging Market ETF. I think that as we see global rates start to lower this year, we're not exactly sure on the timing of that. I think the hunt for yield and growth will resume. And I think in a tracker like this, you don't have to explicitly pick a specific region or country. You get a basket of high growth countries, although South Africa is included in there. We'll take it. But, kind of 26% to China, 16% to Taiwan, 17% to India. So all geographies that I think we're going into an environment that could really benefit investors there.
All right, Richard, keen to get your thoughts on some of those kinds. I mean, we actually have two ETFs. That doesn't happen often, and true it. We've got the S&P 500 Quality Dividend ETF and the iShares Core MSCI Emerging Markets ETF, then as well as Truist, a retailer.
Yeah, so Truist is an interesting one. I mean, it's a bit of a tale of two halves. They had a trading update yesterday, I believe. So yeah, South African business is under a bit of pressure. I mean, for those who live in South Africa, we can look out our window and see what it's like out there. It seems like their volumes went backwards by about double digits. So the South African business is going through a tough patch, but however, they are very good operators, and I do back them to come out of it. But it's a part of a function of the fact that they sort of tighten their credit lending criteria. So it's a large part of their business models is to sell on credit. I think about 70% of their sales in South Africa is a credit sale. So they've tightened their credit lending criteria because of what they're seeing as the deterioration of the credit worthiness of the South African consumer. So it's going through a bit of a tough time in South Africa. However, Office, the UK business, has really done very well for the last 6 months to December, growing revenue by, I think it was approximately 15%, all while space actually contracted by almost 3%. So that is like a fantastic outcome compared to the prior year. And they are now guiding for a 12% increase in space going forward. So you've got this. One part of the business is doing very well, and another part of the business that if South Africa just improves slightly or marginally could really stand to benefit. So I understand the rationale behind Truist. In terms of I can't really speak to the first ETF, but the second one regarding emerging markets. Emerging markets do appear to be, they screen cheaply. So if you want to just broadly get exposure to emerging markets, an ETF would be a very pragmatic way to go about it. I mentioned previously, like China and Hong Kong screen incredibly cheaply. If you look at the South African equity market, we screen cheaply. I think the only equity market, like broadly, that I would think doesn't screen very cheaply would possibly be India, because of the expectations around growth and GDP growth and the development of that country. But yeah, it's hard to argue with getting exposure to other emerging markets at this point in time. And then just to jump into our stock pick,
yes,
just to
please
keep
go
on
ahead.
going.
Please do that.
Please do. So my stock pick is sort of to stay with the theme we've been talking about in the session, is Prosus, and that's mainly because of an exposure to Tencent. And we spoke just now about Alphabet and Microsoft, two tech companies that have very high ratings. I mean, Tencent is also a very good business, but the rating and the sentiment around it has been slowly falling over the last couple of years, to the point now where its forward PE multiple is as low as it's probably ever been. There's been concerns around the future growth profile of the businesses during the festive season. An announcement came out from the Chinese government around regulations around new game releases, which the market didn't take kindly to. So we think the market is probably being overly pessimistic on China, and on Tencent in particular, and our preferred way to access that is through Prosus.
Fantastic, Richard. An absolute pleasure chatting to you this afternoon. Thank you so much for your time. That was Richard Court from Argon Asset Management.